Well, good afternoon, everyone, and welcome to this webinar series. My name is Dan Farrelly. I'm the Senior Vice President and Head of our Financial Institutions channel. Today, we are fortunate to have Jeff Bush with us. So appreciate you joining F&G on this afternoon. Jeff Bush of the Washington Update is known for his unique ability to translate difficult and often confusing information coming out of Washington, D.C. into growth strategies for your clients. Jeff gives it to us straight and in a nonpartisan manner. Every time I listen to Jeff, I walk away better equipped to have better conversations with my clients. Just a quick housekeeping item. At the end of the call today, we will be answering some questions. There is a chat box, a Q&A box on your screen. So type your questions in there and we'll answer as many as we can at the end of the webcast today. So with that, I'd like to turn it over to the man of the hour, Jeff Bush.
Well, thank you, Dan. I really appreciate this opportunity to be back in front of your advisors once again. And just like Dan mentioned, we will have Q&A at the end of the presentation, but I'm also going to have a QR code that if you have your phone's camera ready, you'll be able to get access to the entire presentation, because even though we have an hour today, it's not nearly enough to get through all the details that we would through the full presentation. But when I was thinking about this audience, I've spent a lot of time in and around Washington, D.C., looking at Washington, D.C. through a financial lens. And so I have somewhat of a jaded opinion sometimes about Washington, D.C. And I think this quote perfectly captures that mood. You see, politics is the art of looking for trouble, finding it everywhere, diagnosing it incorrectly, and of course, applying the wrong remedies. Now, I'd love to take credit for that quote, but that quote actually comes from Groucho Marx, believe it or not. So when you know, nothing really ever changes in Washington, D.C., just the topics. And speaking of topics, what we're going to talk about today are changes around that bipartisan retirement bill that's working its way through the legislative process right now. Some have referred to it as Secure Act 2.0. But then we're going to quickly jump into President Biden's platform and the proposals he's made throughout the first quarter and a half or so of 2021 and what we think can actually get passed. Now, I also want to introduce a concept called tax VIX to you. In other words, the volatility of the tax rate environment and what that might mean for planning opportunities and challenges, no doubt, that those changes will impact our clients. And then I want to end our time with a sneak peek into the 2022 midterm election. Goodness knows that's right around the corner as far as political calendars go. Now, that Secure Act 2.0, it really was split into changes for individual investors and plans, 401k plans and the like. And now this is a proposed bill at this point. It's made it out of the House committee, but yet now it has to get passed by the full House and then on to the Senate. So what we're talking about today is what is in that released House committee bill, but that doesn't mean that's what will actually pass. But it gives us a good framework to discuss as to what direction they're trying to head. For example, they want to expand the Savers tax credit that helps lower income families offset the cost of saving for their own retirement. It would also increase the required minimum distribution age once again, although in a little bit funky manner, growing it to age 75, but it would be 73 through 2028. Then through 2031, it would jump to 74, and then thereafter go to 75. It also clarifies that there would be no required minimum distributions for IRA balances less than $100,000. And of course, that's an aggregated amount of IRA money, as you no doubt know. It also would put into place the Roth provision inside the simple and SEP IRA plans. And the thing I'm probably most excited about was the qualified charitable deduction proposal that they put in. Is not nearly as generous as they had originally written. Originally, it would be on an annual basis that you could give up to the full $100,000 through the QCD into a split interest entity. They backed off that dramatically, as we predicted they would, once they figured out how egregiously generous that opportunity would be. So now inside this bill is a one-time lifetime maximum of $50,000 that you can put through the QCD calculation into a split interest entity. Now, that would be your charitable remainder trust, your CRUTs, as well as your CRTs. So now you understand why we were saying it was so egregiously generous, because as you know, a lot of those monies will end up passing on to the heirs of that IRA asset. So this limits the real generosity of that opportunity. It does bolster make-up provisions for ages 62, 63, and 64 should it pass, as well as enhance those to $5,000 for a simple plan and $10,000 for all other plans. Another thing I'm very excited about, especially with some of the tax changes that are being talked about, is that variable annuities would be able to invest in ETFs. The value of that, as we know, variable annuities, once you calculate that all-in cost, can be somewhat pricey. And by putting ETFs as an investment option in those programs, it would lower that total cost. I do believe annuities are going to become increasingly attractive to higher income individuals moving forward. And we'll talk about that when we talk about tax changes. On the plan side, it would build on Secure Act 1.0 by expanding auto enrollment and auto escalation into new plans. It also would change the definition of eligible part-time employees. Instead of working 500 hours a year for 3 years, it would only be 2 years before you'd be eligible to participate in that plan. It increases those tax credits for startup plans, as well as introduces a new tax credit for employer matching contributions. We know through the pandemic, a lot of companies pulled back on some of those matching. They would not only reinstitute that, but perhaps provide a little tax incentive for employers to do such. It also clarifies that 403B plans could join multiple employer plans. The value of that, obviously, is to lower the overall administrative cost to that 403B sponsor, so that hopefully more organizations like that can make those plans available. The most exciting thing on the plan side, in my personal opinion, is that it would allow employers to use student loan payments as qualification for matching contributions in the 401k. I don't need to tell you how important those early years, how important those are for saving for retirement through time value of money. And if an employee was busy paying off student loans and maybe not participating in the 401k, they were missing those so important young years. And this gives them that opportunity to at least quasi-participate in the 401k. Hopefully, once they get the student loan paid off, they would just transfer that investment over to their 401k. Now, the reason this has bipartisan support is it's basically paid for. And it's paid for in somewhat of an interesting way. The catch-up provisions within the plan that we talked about a while ago would actually be made on the Roth side of the calculation. In addition to that, employers now could employer match inside the Roth with employer Roth contributions. Now, it's not rocket science as to why that's a benefit to the federal government. It gets more money in the hands of the federal government now as opposed to 20, 30 years down the road. So they're using that to offset the cost of these changes in plans. Now let's kind of move on to Joe Biden's platform and then the proposals he's put forward. And when I talk about his platform, I'm really talking about what he ran on as a candidate in 2020. I think it's important to understand that baseline foundation of where Joe Biden's coming from so that we can see what direction he's heading now, what things he's added, what things he's actually left out of the plans and the proposals thus far. For Joe Biden, his platform began with healthcare. He was very focused on adding a federal option into the Affordable Care Act exchange that would sit side by side with private insurance offerings. That would allow more Americans to participate in the Affordable Care Act, but more significantly is he'd take the 30 million Americans who are currently uninsured in the United States and auto-enroll them in that federal option day one. On the pharmaceutical side, he wanted to allow Medicare to negotiate for drug prices, which is a bit ironic considering that Joe Biden takes a lot of credit for helping pass the Affordable Care Act, and rightfully so. But it's the Affordable Care Act that actually prohibits Medicare to negotiate for drug prices today. He would enhance Social Security benefits and institute a federally sponsored 401k. Now, I need to be clear, this is not the Federal Employee Retirement Plan. This is just a 401k sponsored by the federal government. It really is designed for the 40 million American workers that go to work every day and don't have access to a qualified plan at work. Lacking that access, meaning their retirement savings options are rather narrow, they could enroll in this federally sponsored 401k and broaden their opportunities to save for their own retirement. He would also make a big investment in hourly minimum wage. He did finally, at some point, come in line with the more progressive wing of the Democratic Party and support a $15 an hour minimum wage. As you know, that was originally a part of the relief bill that was passed earlier this year, but then got quickly pulled out by Joe Biden himself. That doesn't mean it goes away. Finally, he would make a big investment in rebuilding manufacturing in the United States with a big focus on research and development, primarily in green and renewable and climate-friendly type of technologies. And that really pairs side by side with his desires around a big infrastructure investment. He suggested that we should have a $2 trillion infrastructure investment with a heavy lean towards green and renewable. Now, all of these programs, if you add that up, that's over $7 trillion of additional government spending over the next decade. And to Joe Biden's credit, at least he had the guts to put forward as to how he wants to offset a good chunk of that cost. And it started with the $4 trillion tax increase, with almost 100% of that tax increase falling on your best clients, the quote-unquote one percenters. So under Joe Biden's campaign platform, what that meant was he wanted to repeal the Tax Cuts and Jobs Act for the affluent. He didn't define affluent during the campaign, although clearly he said that it will not impact families earning less than $400,000. So that is the income line he's using as affluent. But the word affluent also suggests wealth, not just income. He was very clear that he wanted to raise that highest marginal rate to 39.6%. And probably the thing that's concerning most of your very high income clients is the idea of eliminating the tax advantage lower rates for capital gains on any families earning over $1 million. So for any family that earns $1 million or more, they wouldn't get a discount capital gains rate. They would pay the same ordinary rate, assuming that would be 39.6%. Oh, don't forget, you add the 3.8% for the Affordable Care Act on top of that. He would also cap itemized deductions for any families earning over $400,000 a year at 28% and reinstitute the payroll taxes for any income earned above $400,000. And remember, that's a 12.4% tax, so it's not insignificant whatsoever. And then late in his candidacy, he also suggested that he would limit or eliminate the use of like-kind exchanges or real estate losses to offset other gains in one's portfolio. Now, on the estate tax front, he wanted to lower the unified credit to $3.5 million, but he did not specify an exact tax rate. He alluded to taking the estate tax code back to the way it was, so I'm assuming it'd be in that 40 or 45% range. But more impactful is he also said that we should eliminate stepped-up basis at death. Now, remember, we actually did that in 2010, and it proved to be almost completely unworkable. But more on that here in a moment. On the corporate side, he wants to raise corporate rates to 28% and institute a minimum 15% book profit tax, originally saying that that should apply to any corporation with $100 million in earnings and above. So that's actually a lot of companies around the country, and I don't need to tell you that. But what's also important to understand is that Joe Biden can propose anything he wants, but yet he lacks the power to actually write the piece of legislation. That's done by the House and the Senate members. So it's important to understand that the House Democrats and the Senate Democrats will have a lot to say what this final tax bill would look like should it move forward. And a lot of very important Democrats in this process have been very clear as to what they would like to do. For example, Senator Ron Wyden, head of the Finance Committee, he suggests that forget about no stepped-up basis at death. I want to tax capital gains in the year they're earned. So mark-to-market capital gains taxation. Now, we understand how complicated that would be to do at a one time at death. Can you imagine if we had to do that every single year? It'd be an absolute nightmare. Bernie Sanders, the Senate Budget Committee chairman, is also very vocal as to the changes he'd like to see. He says, forget about that 28% corporate rate. We need to go back to the 35% corporate rate before the Tax Cuts and Jobs Act. On the estate tax front, he would lower the unified credit to $3.5 million, but he then put in a graduated tax rate based on the size of that estate at passing. He would also limit lifetime gifting limits to $1 million while people are alive. And as you know, that would really challenge a lot of our clients in doing very effective wealth transfer planning. He would also close or limit significantly various estate planning strategies that we've used in the past, and I'll talk about that at the end of our time together. Now, there's other talk about financial transaction tax and a wealth tax, but that's not getting any traction at this point, so we're not going to waste any time on that. The takeaway here is to understand that Joe Biden can put forward whatever he wants, but it's the House and the Senate Democrats that will actually eventually write this bill. Understand that any bill that's budgetary, debt, taxation, anything like that passes by a process called reconciliation. inside the Senate. The reconciliation rules in the U.S. Senate says that you don't need that 60-vote threshold to pass a piece of legislation. For these unique type of bills, it only requires a simple majority. It's the exact same way that Donald Trump passed the Tax Cuts and Jobs Act of 2017. It's the exact same way that Joe Biden passed the $1.9 trillion relief bill earlier this year. And it's more than likely this is how these bills are going to be moving for the remainder of the year. The real question is, when can we expect some of these tax changes to go into effect? Is it possible that they could write it in such a way that they backdate it for tax year 2021? Absolutely. They could absolutely do that. I just don't think that's going to happen. I think some of these changes could take place on the day of enactment, but the majority of them will likely push to tax year 2022. Giving us some time to do some preparation for that eventuality. But now that Joe Biden and the Democrats control the House, the Senate, and the White House, I want you to be aware that Republicans are going to rediscover their fiscal conservative roots. And we heard some of that during the $1.9 trillion relief bill. But you're really going to start hearing that as the negotiations ramp up around this infrastructure bill and beyond. But I thought it'd be helpful to go through a yes, no, maybe analysis of what we think can pass given this new political reality in D.C. Now, normally, and again, I'm preaching to the choir, in a single party control, you would expect the markets to be rather anxious. The markets understand the only thing worse than an underachieving Washington, D.C. is an overachieving Washington, D.C. And that's certainly what single party control does for you. But the reality, uniquely in 2021, is that the markets are being buoyed by all this stimulus being added to our economy. And I do believe the economy the markets will do just fine as long as that stimulus is being added into the economy. The real question is, what happens when daddy starts to take the sugar away? And I think that's when we could start seeing that normal market turbulence around single party control, perhaps later this summer or into this fall. We do believe tax reform will get done, but tempered from what we went through under Joe Biden's plan, as well as the fact of that bipartisan retirement bill that we talked about, the Secure Act 2.0. It already has the votes to pass. It's just trying to find the right mechanism, the right conduit, if you will, to actually get passed. And it could be one of these infrastructure bills or the like that it gets tagged onto, or it could go standalone. We just don't know yet. Obviously, under a Democratic control, you have to assume more progressive judges will be named to the federal judiciary. The Republicans over the last 2 years were very successful in filling the federal bench with Republican or more conservative judges, and Joe Biden and the Democrats obviously will go the opposite direction. As much as Joe Biden would like to be that transformational domestic president, I have a feeling that foreign matters are going to creep into it. Certainly, we've seen the Israeli-Palestinian issue really ramp up over the last 10 days or so. But beyond that, you have the U.S.-China trade relationships, which at this point, Joe Biden seems to be just taking Donald Trump's plan and putting his name on it and continuing down that same road. But we have the Russian issue with them putting bounties on our soldiers' head and seemingly state-sponsored cyber terrorism and so forth coming out of Russia. You have the Iranian nuclear deal. A lot of people question why Iran signed on to this 10-year delay of any enrichment. It's because the Iranians know how to make a bomb. They know how to enrich uranium. What the Iranians lacked was a delivery mechanism for some future weapon. So they were fine with a 10-year hiatus to get some of those relief from sanctions and so forth, because they had to develop that delivery mechanism, which was not severely limited under the JCPOA. You also have North Korea. They've been somewhat quiet during the pandemic. I think Kim Jong-un will find a way to make his presence known sooner rather than later post-pandemic. We also anticipate under Joe Biden presidency, while Donald Trump presided over a time period of broad-based deregulation, Joe Biden's going to reverse that trend. Now, we haven't seen a lot of that lately because regulation change usually takes quite a bit of time to actually put into effect. But remember, unlike legislation, the regulatory control, for the most part, is completely under the president's purview. So that is a 4-year time frame that we could see some significant regulatory changes under the Joe Biden presidency, unlike the legislative stuff, which really needs to get done before midterms next year. But even with the Democrats controlling everything, you're not going to see the Green New Deal or single-payer healthcare system, full college loan forgiveness, or defunding the police in its literal sense. But what could happen is that federal option within the Affordable Care Act exchange or immigration reform, Social Security enhancements, a green-ish infrastructure deal, which we've already seen positioned or put forward, as well as measured student loan forgiveness. And the reason these things are in that maybe category is because they are subject to that filibuster rule within the Senate. Remember, reconciliation bills, budget, tax, and things like that can pass with a simple majority, but all these other issues have to pass with a 60-vote threshold within the Senate called the filibuster minimum. Now, it's possible that the Democrats could bust the filibuster. Well, because it's a Senate rule, interestingly, it only requires a simple majority to actually change that rule. So the Democrats have the votes to actually bust the filibuster, but there are some holdouts within the Senate Democrats saying they will not, under no circumstance, vote to bust the filibuster. Well, that could be a temporal position, so watch that. That could change over time. But in addition to that, the Democrats could move to just tactically change the filibuster. They don't have to get rid of the whole thing. They could just change it for a very narrow scope of legislation. So there's a lot of flexibility there. And I think what could motivate the Democrats in that direction would be if the Republicans are just seen as being completely recalcitrant, they're not negotiating in good faith, and they're not going to give President Biden any opportunity to put a bipartisan piece of legislation through Congress. If they perceive that, that's when the pressure will really start to build on that filibuster busting and so forth. So we'll see if that heats up over the next couple of months as this infrastructure bill and social bill are moving through Congress. Now, Joe Biden takes a very holistic view of retirement, and that starts with Social Security enhancements. He would like to end means testing within Social Security, and he didn't really define that, but the only thing I can think of is that earned income offset. That's really going after the fact that a lot of your clients who are retired and still earning a W-2 wage, as you know, their payments are reduced. I'm assuming he just wants to get rid of that reduction. In addition to that, once anyone's been on Social Security for 20 years, they would just automatically get a raise. And he would increase the minimum benefit back to 125% of the federal poverty level. That percentage had been allowed to drop precipitously over the last several decades, and because cost of living increases have been so small. Now, we did get some good news. It does appear the 2022 cost of living increase will be quite substantial, could be north of 4%. So that could dissuade the president from moving in that direction. And he hasn't really put anything forward around Social Security. Interesting to point out, Social Security, while certainly has budgetary impact and tax changes, is the one thing that can't get changed via reconciliation, even though it's a budgetary item. So it would require that filibuster minimum 60 vote, unless the Democrats bust that. So that could be that issue that finally breaks that camel's back. We'll just have to wait and see. He would like to lower Medicare eligibility to age 60 because health care is a part of Social retirement as far as Joe Biden's concerned. And on the retirement savings front, beyond that federally sponsored 401k, he ultimately would like to change the system from a pre-tax savings environment to a tax credit environment. The belief there is that lower income families, if they have no federal tax obligation, then what good is pre-tax savings? It's meaningless to that family. So by converting it to a tax credit system, they're actually incented to save for their own retirement, which we could all agree is a good thing. If that tax credit is meaningful enough, and I'm talking about 25 to 28% tax credit, it really would be a wash for the mass majority of your clients. Now, beyond that, let's get into some of the coronavirus relief thus far, because it really is being split now between relief, and we're done with relief. Now we're moving towards recovery. But in that relief effort, we've passed numerous rounds of relief bills totaling $5.6 trillion so far. Now, those monies are appropriate and will be spent over various timeframes, some of them quite long timeframes. But just to put that $5.6 trillion into perspective, if you go back to fiscal year 2019 and you count every single dollar the federal government spent in the entire year, it was only $4.5 trillion. So hopefully that gives you a perspective of just how much money we've added on top of normal spending towards the coronavirus relief. But Joe Biden now has put forward his recovery bills as well. And that would actually grow the appropriated dollars towards coronavirus from $5.6 trillion to $9.7 trillion. So again, think of the comparable there. Now, what it's focused on is really a two-part process in this recovery plan, which totals over a $4 trillion deal. And I don't think it's hyperbolic to suggest that these two bills are certainly the most significant in my lifetime and our generation. Certainly since the New Deal and civil rights legislation of the 60s and the 1930s. Now, Joe Biden has put this forward in the form of two bills, as you no doubt know, the infrastructure bill as well as a social initiatives bill. And that somewhat is completely irrelevant. This could all be merged into one. It could be split into two, with one being just true infrastructure and the other one including everything else. It's all over the map right now. So don't get too hung up on the fact that there are two separate ones. Just know that these are the issues we're dealing with. On the social initiatives bill, we're talking about extending that refundable tax credit that was passed in the relief bill earlier this year through 2025. Universal pre-K, free community college, as well as paid family medical leave. But what I was most struck by was what was actually left out of Joe Biden's social initiatives bill, that federal option to the Affordable Care Act exchange and lowering the eligibility of Medicare to age 55 or age 60. That wasn't mentioned at all. Nor was Medicare being able to negotiate for drug prices nationally, which would have funded some of those Medicare changes. Now, my theory is pretty simple. I think there's two tracks that Joe Biden's running on. He did not include it because if he made those changes, that $4+ trillion would have gone north of $6 trillion, which is just maybe too big of a pill to swallow, as you can imagine. But what I think is he left it out. He's counting on the House progressives and the Senate progressives, Democrats, to put healthcare back into that bill. And Bernie Sanders says he will not vote for this bill unless it lowers eligibility of Medicare, and in his mind, to age 55, as well as allowing Medicare to negotiate for drug prices. So you can see that track seems to be working at this point. Or the second track would be, for some reason, if it's not put into this program, perhaps Joe Biden does a standalone healthcare benefit or healthcare bill later this year, with the eyes that will drive the narrative around the 2022 election. So we'll see. We don't know what track we're on, but that seems to be the direction Joe Biden's going around healthcare at this point. Now, the infrastructure bill includes traditional infrastructure and non-traditional. Republicans are suggesting that only 5% of the $2.25 trillion bill is actually infrastructure, where Democrats say 90%. Well, clearly, they both can't be right. So what I thought we'd do as a little fun exercise that I think will be enjoyable is let's go line by line down through the infrastructure bill and decide what is infrastructure and what's not. Now, of course, I say that just because, to be honest with you, a lot of this is very subjective. But I do think the Washington Post did a pretty good job of breaking the law down into what is traditional infrastructure and then what's not. In this salmon color, if you will, in the upper right-hand corner, I think the majority of that is traditional infrastructure. And I think you can make a pretty good argument that some of the blue money is traditional infrastructure as well. Now, once you get into the green money in other areas, there's no way that's infrastructure. So I think the most honest intellectual argument around this issue says that the infrastructure bill is about 40 to 60% infrastructure. If Democrats and Republicans were honest with themselves, I think that's the debate frame, 40 to 60% rather than 5 and 90. What's my 2 cents worth, though? But what we do know is that that infrastructure bill includes a lot of things that aren't infrastructure. Even the Democrats would admit that to some degree. So the question is, why did Biden put it through as an infrastructure bill? Well, it's pretty self-serving. You see, everyone agrees we need an infrastructure bill in Washington. Nobody disagrees with that. And the reason why is the American Society of Civil Engineers gives our current infrastructure a grade in the United States of C-. Now, I know that doesn't sound very good, but for some, it's actually better than it was. We were actually D- or D last year, D+. So somehow we got a grade improvement over 2020. I don't know how that happened, but now we're at a C-. So it's not a debate of do we need an infrastructure investment? It's how do we pay for it? That's where the negotiations always break down. And if you've listened to Andy or me speak over the last 2 or 3 years, we've told you since the fiscal conservatives lost a lot of power in the House of Representatives back in 2018, it opened up a new dialogue around infrastructure investment, away from gas taxes, fines, and fees to something called deficit-financed infrastructure investment. In other words, let's just borrow money, and interest rates are rather low. Let's borrow money and build whatever we need to build, probably in the form of those Build America type bonds. They were obviously very popular. Now, that's all well and good, but the reason why we hadn't had a deficit infrastructure bill previous to this was there was no impetus for it when unemployment was 3.5% and wages were going up and so forth. There was just no motivation for making that happen. But enter the pandemic. As an economic recovery bill, remember, we've passed relief, now we're on to recovery. So as a recovery bill, economically, you can see where infrastructure makes a lot of sense. But I think it is important we get on the same page. Whether you're talking about Joe Biden's $2.25 trillion, you're talking about the Republicans' counterproposal at $600, they're talking about raising that to $800 billion, it's still somewhat inadequate. That same Society of Civil Engineers says that if you want to get that C- grade up to a C+, you need to have over $2 trillion of investment over the next 10 years. And if you're so bold as to think the United States deserves world-class infrastructure, the number's north of $4 trillion. So no matter what numbers we're talking about, it's still a challenge for our country, no doubt. Now, here's where we need to do a little budgeting education. You see, there's two ways to talk about a bill from a budgeting perspective. You can talk about it as baseline plus or an inclusive bill. Baseline plus means that we know we're going to spend a bunch of money on infrastructure over the next 10 years. So baseline plus says we're going to assume we're going to pay that, and then we're going to add money to it. And that's what Joe Biden did. So his $2.25 trillion is on top of what we were already going to plan on spending for infrastructure over the next 10 years. Republicans, on the other hand, is an inclusive budget. So it already takes into account that we were going to spend $400 to $600 billion over the next 10 years on infrastructure, and it's just adding a couple $100 billion on top of that. So the real debate when you're saying, can the Republicans and Democrats get together on these numbers? If you believe my 40 to 60% number of Joe Biden's infrastructure bill, so is really the debate is 1.1 trillion to 196 billion. And can they reconcile those two numbers and what they want to spend money on? So you can see the Republicans and Democrats are very far apart at this point, and I'm not overly optimistic that we're actually going to see something done. Now, when I described inclusive budgeting, because the Republicans weren't overly upfront about that when they gave their $600 billion number out there, it doesn't mean Joe Biden's not playing a little bit of funny budgeting as well. He's using that famous 15 or 10 by 15 plan. And what I mean by that is he wants to spend the money over 10 years, but pay for it over 15 years, which means we're going to be paying for this 10-year bill for 5 years after it's over. But that takes money away from the monies that we can invest in infrastructure then. So it's a little bit of funny math there as well. So it's not clearly as simple as saying one number over the other. And that really brings us to how we're going to pay for these proposals. And that's where we get into this discussion about tax VIX, or volatility of the tax rate environment. You're probably familiar with that quote from Benjamin Franklin that says, "Nothing is certain but death and taxes." You may not be as familiar with this next quote. It's actually one of my favorites around tax policy. It's from Will Rogers. He said, "The only difference between death and taxes is that death doesn't get any worse every time Congress is in session." I think that's a great quote. But Joe Biden actually gave us a new quote around taxes, which I think is equally as interesting. He said that wealthy individuals, high-income individuals, and corporate America need to be prepared to see a small to substantial tax increase. And why I think that's a little funny is he certainly left himself a lot of room there to work within that parameter. Now, kind of moving into the details, I mentioned that $9.7 trillion a moment ago. But that has real implications because assuming we don't pay for all of that in tax raises, it means it's going to add to the debt. Now, this chart goes back to the pre-$1.9 trillion relief bill, okay? The one that we just passed in March. Remember, we're dealing with the federal government. So this, they updated in March the bill that had passed in December at $3.7 trillion. You can see that $3.7 trillion fundamentally reset that debt to GDP relationship and put us on this unsustainable course. Compare that to the height of World War II, which is a comparison we're often hearing these days, where we barely eclipsed 100% at the height of the war. But then we paid the debt off very quickly. We paid that debt off in two ways. We had incredible GDP growth coming out of World War II with all the soldiers coming home and starting families and building houses and the like. And we actually paid off the war bonds. I question you, where's the government's plan moving forward? I think that's what concerns me the most. You see, it's not necessarily a revenue problem. Revenues are expected to remain relatively flat, around 18% of GDP. So as GDP is growing, so will revenues to the federal government. It's that outlay line that concerns me the most. In other words, what we're spending. So if we break down what is projected to be spent over this time frame, you can see what's really changing. Yes, to some degree, as the increased cost of Medicare as our population ages, but the lion's share of the increased spend is coming from interest only on the total federal accumulated debt. Interest only. Remember, we don't pay off principal. And again, this is based on 3.7 trillion. So what happens if that number goes to 6 trillion or even more? Of course, the slope of that line is going to go up substantially. It's this slide, ladies and gentlemen, that convinces me, Republican, Democrat, it doesn't matter. Over the next 10 or 15 years, revenues to the federal government as a percentage of GDP will be going up. I can just see that as plain as day. Another way to look at it is looking at the projected budgets. Now here I'm looking at the 2022 projected budget based on that 3.7 trillion in additional debt. And the reason why is I wanted to get the pandemic noise out of the numbers instead of looking at 2021. You can see we're spending about 6% of the federal budget on interest only on the accumulated federal debt. About 62% of the federal budget are mandatory spending, meaning Medicare, Medicaid, and Social Security. But that leaves about 1/3 of the budget going for discretionary spending. Now, discretionary spending is defense, so everything about DOD, and then all the other stuff the federal government spends money on. All the federal agencies, the IRS, the EPA, the Energy Department, all of that stuff, all the buildings, all the national parks, all the courthouses, all of that, as well as DOD, is in that discretionary budget, and that's about 1/3 of the budget in 2022. But look what happens over the next 10 years. By 2031, that mandatory spending is up to 2/3 of the budget. Interest only on the federal debt's already up to 10%. Again, at 3.7 trillion, it's up at 10%, and it's putting tremendous amount of pressure on discretionary budget, which is kind of concerning. That means 25% of our revenues, or 25% of our economy, is just working to fund the other 76% or 75% of our budget. I don't think that's healthy long term. If that was a business that came to you and wanted a loan, I don't think you'd feel very comfortable in the direction of their balance sheet. So what we need to understand is around taxation. A lot of people are talking about, oh my God, going back to 39.6% interest rates. What we need to understand in the history of highest marginal tax brackets, 39.6 isn't really historically high. The average is around 57%. But you know that old cliche about averages, right? If you have your hand in a pot of ice water and another hand in boiling water, on average, you feel pretty darn good, right? But clearly that's not healthy. And so what we want to understand is what's happening to effective tax rates, because effective tax rates are what we actually write a check for. And here we look back in history and we see something very interesting. You see, even when the highest marginal tax rates were 92, 94% back in the 50s, the average effective tax rate wasn't really sizably more than it is today. So, just to help you understand a little bit about that, I thought that was very interesting. So in my mind, a lot of individuals talk about the progressivity of the tax code. And what they mean by that is who's actually paying taxes. Well, the question is, do we have a progressive tax code in the United States? We absolutely do. And this slide, I think, justifies that, where the lower 50% of wage earners pay 4% or so, where the top 50% pay 96%. But let's be honest, that's not where you work. You work in the top 1%, the top 0.1%, and there you can see that clearly we have a very progressive tax rate environment. But what if there's one thing that Democrats do agree on universally, progressives or more moderates, is they want to increase the slope of the progressivity of the U.S. tax code, meaning higher income, higher net worth, and corporate America shouldering a larger share of a larger tax burden. And I think that's very clear. We need to understand that heading into this situation. Joe Biden has been very clear as to what direction he wanted to take taxes. Democrats are playing right along with that. And so where we stand right now is what's being put forward is the fact that the highest marginal tax rate would go to 39.6%, but he did nuance that to some degree. A lot of people assume that that would be for people earning $400 or more, but he actually went back to the marginal tax bracket, the highest marginal tax bracket of 2017, so prior to the Tax Cuts and Jobs Act, and then index that forward for individual taxpayers and joint filers. He would also bring capital gains tax rates for high income earners up to that 39.6%, remember, plus the 3.8% on top of that. That's a part of that plan, and eliminating 1031 like-kind exchanges for larger real estate gains. Now, those are certainly concerning, but probably what you're hearing most from your clients, certainly the majority of your clients, is that elimination of stepped-up basis. There is some nuance to that as well compared to what he originally put forward. Right now, he's suggesting the stepped-up basis should be eliminated for any individual portfolios north of 1 million and couples over 2.5 million. There's a charitable exception for that. So if they do charitable giving, that doesn't count against them, or they don't lose that stepped-up basis there. He would put into place protection for family businesses and farms for those children involved in the operation. So theoretically, the way I'm reading the proposal is that if you have a family farm and one child is working the farm and the other child isn't, the one child that's working the farm would owe capital gains, but the child that doesn't would owe capital gains at passing. Now, there's some debate whether the capital gains are due at passing or when the children sell the asset. It's been reported both ways. It's been talked about both ways by elected officials, so we really don't know exactly when those capital gains would be due. But it does bring forward, if you're going to make exceptions for certain assets, why not other assets, non-readily tradable assets? You can see the complication there. What about resurrecting basis for long-held multi-generational assets? My great-grandfather bought a piece of land that's still in the family, years and years and years ago. Well, none of us have any idea what great-granddad paid for that piece of land. But yeah, theoretically, you'd have to resurrect that basis from a capital gains perspective. Now, we think the sheer complexity of this whole stepped-up basis scenario and trying to make exceptions here and not over here just means that it's unlikely that that's the direction of tax policy moving forward. We think what's more likely is they'll bail on that elimination of stepped-up basis idea and go to something much, much simpler. And that would be lowering the unified credit to $3.5 million, probably with $3 to $6 million, I should say. They could go back to that $5.6 million and index that up as well as a rate between 40 and 45%, and perhaps get rid of that lifetime gifting limit to the unified credit and lowering that to 1 million. We think that's just much more realistic as a way of implementation of, quote unquote, increasing the progressivity of the code and having the wealthy pay their fair share. Now, the tax gap is also something that the Democrats are planning on using to help offset the cost of these programs. And what they mean there is taxes owed that go uncollected. And some have suggested that could be as much as $1 trillion a year that go uncollected. Now, keep in mind, we only spend about $4.5 trillion a year as a federal government. So $1 trillion, and let's say it's even $700 billion. That would go a long way in helping close that deficit gap in our country. Some Democrats, specifically in the House of Representatives, are saying they will not sign off on any tax program unless it gets rid of that cap on state and local tax deduction. Well, that's a real thorn in Joe Biden's side because that is a huge amount of money. And so the concept of getting rid of that SALT cap blows everything apart. It just simply doesn't work. So I think what's more likely, instead of a discussion of keeping the SALT cap at 10 or getting rid of it, I think we'll end up in a much more nuanced environment. I think we'll probably see a lifting of the cap or elimination of the family or the marriage penalty, or perhaps just instituting that tax cap based on an income threshold. So only families above a certain income would have that $10,000 cap. I think that's more realistic of where we would end up in that SALT discussion. On the corporate side, again, 28% is where Joe Biden wanted to take the corporate rates. We think that's likely going to fall to 25%. But that's a significant revenue shortfall that will have to be made up elsewhere. He wants to increase the global minimum tax from 13% to 21%, so basically a 50% tax increase there. And it would also require other OECD economies to buy into that. Well, economies with high tax rates are saying, sure, that'd be great. Economies with low interest rates, Ireland and the like, are saying, heck no, we're not going to go that direction. So there's a lot of work to get that actually implemented. He also suggests that 15% minimum book profit tax instead of being on corporations of 100 million and above, too many. So he's going to 2 billion and above. Well, now you're only talking about 200 companies around the country, so sizably fewer corporations would be impacted by that, but it's still a pretty good chunk of money, no doubt. He wants to permanently extend the limitation. No, I should say those things there primarily deal with corporate taxes. Let's talk about pass-through business owners. That's a lot of your clients, as you know. One of the things that you need to pay attention to is permanently extend the limitation that restricts the use of business losses to offset non-business income. That's certainly something inside the Tax Cuts and Jobs Act that's been a part of our tax code for a while, and he would make that permanently extend that. It would also eliminate the carried interest loophole, so those incomes would be taxed at ordinary rates, not capital gains tax rates. It also would end the practice of that 3.8% Medicare tax. There's a loophole there where non-wage earnings from a limited partnership or S Corp or LLC, those aren't being subject to the 3.8% tax. Now that sounds a little nichey, but let me tell you, it's a really big number. There's a lot of income flowing through partnerships in that construct, which would be subject to that 3.8% tax. The Democrats obviously want to make that to bolster the spending on Medicare, as well as in fossil fuel subsidies. Now, when I think about 2021, and I do a ton of client events for advisors around the country, and so I'm talking to clients quite often, I remind them to make sure their financial plans are up to date. We know we're heading into a time of uncertainty and volatility and perhaps significant change. That's no time for your financial plan to be out of date. And I know, again, I'm preaching to the choir. But what I also talk to your clients about are Roth conversions. Roth conversions in the sense that tax rates are historically still relatively low compared to average. But if the market gives us an opportunity through some of this volatility we anticipate here in 2021, let's use that to take advantage of that Roth conversion. And what I talk to advisors about is help your clients make that intellectual decision today, so you aren't trying to educate a client in the midst of all the emotion when the market does drop. So make the intellectual decision today, and then it's just a matter of executing that when the market gives you an opportunity. But I also talk about insuring against the most predictable bear market in any investor's life, and that's a long-term care incident. You and I both know that the tools that we have available to us today are infinitely more consumer-friendly than we had even 2 or 3 years ago. But I spend the majority of my time talking to your clients about marrying the right asset allocation to the right asset location. We have asset allocation strategies to mitigate market risk. We have asset location strategies to mitigate tax volatility risk. And what I'm implying is that if the slope of the progressivity of the U.S. tax code is going up, which I do believe it is, that means annuities for tax timing and guarantees to some degree, but life insurance for tax-free income, life insurance for wealth transfer planning, tax-free, tax-efficient investing are going to become increasingly valuable to your very best clients. So it's imperative that you brush up on those tax avoidance and wealth transfer strategies, and quite honestly, some of the things we used to do not that long ago in the financial business. But those marginal rates do go up. You're going to look to accelerate deductions and defer income. Obviously, annuities and life insurance can be very beneficial in that format. If the capital gains go up, you may consider selling some highly appreciated assets now while the capital gains rate is low and immediately buy it back. Obviously, there's no wash sale rules in that situation. You could also donate appreciated property. Harvest losses, buy and hold strategies become more effective for your highest income clients, and professionally managed tax advantage strategies will again become very much in vogue, much more so than it is now even. Like kind exchanges of real estate, if that's eliminated or limited, you may very well accelerate the sale of a property, or kind of a buy and hold strategy on real estate. You know, that may go against some of your clients' thoughts traditionally on real estate, but if the capital gains tax rates goes up sizably, it may make a lot of sense for them to think through that. Remember, for your non-tax itemizing clients, about that deduction bunching. So if, for example, with the increased standard deduction, if they donate $10,000 a year to school and church, have them bunch together 3 years of that and donate it all in 1 year. That way they can take advantage of the higher standard deduction the first 2 years, and then the third year they get to take the full charitable deduction. It's just a little bit smarter way to think through how a client does their giving. I really am a big fan of the QCDs. I think that will continue to be a great strategy for your clients. And I'm also assuming that estate tax exemption could easily go down. And what that means is we need to re-engage our clients about active giving and giving now. Survivorship life insurance that through an ILET, or children outright owning the policies on mom and dad. All of those strategies are going to become back in vogue. But I mentioned earlier that Bernie Sanders is really focused on some of these loophole closures around wealth transfer planning. Here's exactly what I'm referring to. He's put forward that those annual gifts of $15,000 to as many recipients as you like, that should be limited. And in a proposal he put forward, it would be limited to 2. So I could give to 2 and my wife could give to 2. So you can see that would be a significant change. He would also set much less generous parameters around the guaranteed remainder annuity trust, dynasty trust. He's suggesting that they should only go for 50 years and then be subject to generation skipping tax at that point. Limitations on the types of assets can actually be discounted through family limited partnerships and other discounting strategies. Charitable trusts are not likely going to be impacted. That's an activity they definitely want to incent. But these kind of loophole closures would likely go into effect on the day of enactment. So I'm just trying to give you some heads up. That could change at pretty quick order at some point here during 2021. Now, real quickly, I know I'm kind of going long because I want to leave time for Q&A, but when I think about the 22 midterm election, we need to talk about the House of Representatives and understand this is a redistricting year. So based on that 2020 census, we're going through that redistricting process right now, and the Republicans definitely have the advantage, again, just like they did in 2012. Right now, the Republicans control the redrawing of 181 seats, where the Democrats only control 76. And that's primarily because they own the majority of state legislatures, they own the majority of gubernatorial mansions, and that gives them a lot of that redistricting power. But remember, the Republicans had that advantage in 2012. So quite honestly, they've already gone through that process. I don't think gerrymandering will be nearly as impactful as some people are suggesting that it will be, primarily because it's already been done by a large part. History certainly is to the Republicans' advantage in this midterm election. There have only been 3 elections in the last 55 where the in-power presidential party picked up seats in that midterm election. So certainly history is not the friend of Joe Biden in this situation. And that's why I'm suggesting that I think the Democrats are going to be much more aggressive than they normally would be during this first 18 months of Joe Biden's presidency, because I really do believe they think that may be their only chance to prove their policies are the better direction for our country. There are a lot of Democrats retiring, running for other offices simply because they see that writing on the wall. In the Senate side, the Democrats have some advantages, some disadvantages. The advantage the Democrats have is they're only defending 14 seats, where Republicans have to defend 20. And Republicans, remember, only need to pick up 1 net seat in order to gain a majority. That's it, 1 out of 34. So if they pick up that 1 net seat, they would take majority, and that would stop any planning from Joe Biden. So the Republicans to watch are Wisconsin, Pennsylvania, North Carolina for various reasons. And on the Democrat side, you have Arizona and Georgia. Now, I know what you're thinking. You're thinking Mark Kelly and Raphael Warnock, they just got elected this year. So why are they up again? Well, they're up again because both of those were special elections. And I would argue that Georgia is clearly a red state. It was just a unique circumstance that the 2 Democrats won in 2020. I don't think that's necessarily, at this point, known for 2022 and beyond. Arizona certainly is a purplish state, so you could see that go either way. I think the real wild card for 2022 really is Donald Trump and what role he plays in the 2022 midterm elections. He seems to be ramping up his activity. But at some point, my belief is the Republicans are going to have to give voters a reason to vote for them. You can't, it's just a limited motivating cycle to talk about 2020 over and over and over again. You've got to give those more moderate Republicans and independents a reason to vote for the Republican agenda. So we'll see if they come forward with some thinking around that. Right now, they don't seem to be too anxious to get that out, but of course, it's very early in the 2022 race. So with that, I told you that we are going to do a subset of the presentation today. I have a lot more slides that go into more depth in Joe Biden's platform, a lot more depth around big tech and trade and things like that. You're more than welcome to it. Just open up your phone's camera, focus it on the QR code here on the right side of the screen. A pop-up will come up, tap the pop-up, share your email address with me, and I'll be happy to get the presentation to you. But then more tactical than that, and it does take me about 24 to 48 hours, so you only have to do it once, but it may take me a day or two to get it to you. More tactical than that, though, my colleague Andy and I spend 4 to 5 hours a day reading and researching, and we select 2, 3, 4 articles a day that we think are uniquely valuable for whatever reason, and we post those on our social media as well as our own app. All of this stuff is no charge to you. We don't sell anything to you. We don't sell your information. It's just thanks to F&G for having me here today. So with that, I'm going to turn it back over to Dan and see what questions we have.
Great. Thank you, Jeff. It's truly amazing how much knowledge you can pack into 50 minutes. It's impressive. So thank you again from F&G for being here.
Are you there, Dan?
Just you got him, then we'll do Q&A. A lot of questions about whether or not there'll be a replay. If you are appointed with F&G, it will be on SalesLink, our agent advisor portal, which is saleslink.fglife.com.
See if I got disconnected.
So first question, will the federally sponsored 401k include taxpayer-funded matching contributions? Good question.
That's a great question. It's ill-defined at this point. My general take on that is at this point, no. It really is just to give them access to that larger savings opportunity than a traditional IRA and so forth.
Got it. What do you think is there enough political will for making necessary changes to Social Security to get it where it needs to be for the long term?
Not today. We elect these people in 2, 4, and 6-year terms, right? And we know that bankruptcy date of Social Security, which is a horrible name. We all understand why it's a horrible name. But that date still looks to be about 2032, 2033. And so assuming that that's true, I don't think we're going to find that political will to actually deal with Social Security on a true proactive basis until late in the 2020s. So 2026, 2028, that type of time frame, maybe even a little bit later. We'll know they're serious when they're willing to deal with all the variables of Social Security at the same time. Social Security is a math formula, right? And there are only so many variables in that math formula. So if they're willing to tweak all of them at one time, that's when we know they're serious. That's the tax rate, the tax cap, early retirement age, full retirement age, and yes, means testing as well. Now, the one exception to that, all those changes would likely only impact younger people. The one exception would be going to the chain CPI, right? That's the CPI index for that's a lower calculator. They're talking about applying that to current and future retirees.
Thank you. We got time for one more, and it's a two-part. So how concerned are you about the debt we're incurring as a country, and do you think we could ever have a balanced budget?
Yeah, the balanced budget, no. I don't see how that math works at this point. Go back to that slide with the payments going up and so forth. I just don't know where you're going to cut it enough to actually solve that problem. Revenues would have to go up literally 30% at this point on an annual basis in order to catch up to a balanced level. And I just don't see that happening. And quite honestly, we don't need to balance the budget. We just have to get the deficit down within a manageable growth rate somewhere around GDP. So around 2% a year. The problem is the federal government doesn't want to do that. They want to spend more than that on an annual growth basis. Now, the other part is, am I concerned about the debt? Not today. I'm not concerned about it today because every OECD country is adding debt as a percentage of GDP. So and this whole concern about debt is a relative measure against other options. In other words, the other OECD countries. And with all those countries adding debt, no one's going to really know how we compare post-pandemic on a relative basis for probably 2 or 3 years. I think that's the time frame where we could see some concerns that way. Now, could that accelerate with inflation and things like that? Absolutely.
Wonderful. Well, we are at the top of the hour. Jeff, as always, thank you so much. On behalf of F&G, thanks to the audience for joining us today. And that will conclude the webcast.